That was Netflix co-CEO Ted Sarandos talking about the company's content pipeline during the earnings call last night. Shares are down this morning despite beating estimates and raising their guidance. Joining us this morning with his take is Michael Morris of Guggenheim Securities. Raises his target on Netflix to $14.50 from $1400 with a buy rating. Happy Friday, Mike. Good to see you.
Good to see you too, Carl.
That phrase, a steady drumbeat from Ted, doing a lot of work there, and it kind of explains certainly what he was talking about last night regarding amortizing content, right?
I think that's right. Netflix continues to grow. It's a bigger company. It has bigger expectations, and it has to continue to appeal to a broader set of consumers with a broader set of tastes. And so it's not about one show or one title, as Ted said yesterday. It's about expanding the shows, expanding the titles, expanding the genres, the geographies, and the formats. And I think that that's core to the thesis. I think it's what you're going to see in the coming quarters and coming years.
Do you think the street was hungry for maybe a little more robust guidance on at least Q3 operating margin?
Well, I mean, you can't deny the reaction in the stock this morning, which is off a little bit. So there's always a set of expectations going into earnings that will be lived up to or not. So I think you could say yes. The beat and raise that the company did deliver was not quite as big as maybe what the bullish case expected. But that said, I think we're talking about one minute of one day with respect to the stock reaction. Our position is that the drivers of the beat and raise are sustainable going forward. They're generating incremental momentum. And importantly, where I think we have a differentiated call in our long-term buy thesis, is that the company is generating that steady drumbeat that we talked about before from a position of strength relative to its peers. And I think that's going to serve them very well and serve investors very well for the long term.
There was a lot of talking up of the second half, the strong content slate and what they're expecting as far as engagement. What are you expecting on that front?
Yes, well, it's a great question, Sarah. The topic of engagement is very important to the company, and it is probably core to the greatest concern case on the shares. And that's that the engagement has grown relatively modestly as measured by the number of hours consumed, 1% in the first 6 months of the year, compared to the overall membership growth, which is up close to double digits over the last year. So the concern is that, hey, people are not spending as much time on Netflix, even as they're signed up, and does that create some problems for the future? Our view is that engagement trends will improve in the back half of the year and beyond for a couple of reasons. One, there is a more robust content slate. It started with the release of Squid Game 3 at the end of the second quarter, which drove more engagement. But there is a robust slate of titles, including returning series like Stranger Things, Wednesday, a new Happy Gilmore film. So that's core in the near term. In the longer term, though, it continues to be about expansion, not just hits as we know them now. Right. In our opinion, live is going to be important, sports increasingly important, and more global growth.
Yeah, maybe more from Squid Games, which got 122 million views and came at the end of the quarter. I did watch it. It's a really sick season. But Michael, advertising growth, how much does it play into the beat and the view forward? Is that sustainable, for instance, into next year?
Yes. So advertising is an important part of the story, arguably a more important part of the story than it is the financials in the near term. The reason is, if you think about the growth in the business, it's coming from several places. The biggest drivers right now are still membership and pricing of subscriptions, but advertising is growing at a very high rate. We expect it to more than double this year and really become more of a contributor to the financials. That matters, but also another way for consumers to engage with the platform. And that's really critical. Giving consumers more choice with respect to how they will compensate the company for the content is important. Netflix has done a tremendous job of building out its advertising technology, building out its advertising relationships, and we do think that will come through in the back half of this year into next year with that doubling. But it's still relatively small and has a lot of runway for growth.
Finally, Mike, a couple other big stories in media. One is our own parent, Comcast, going to raise some pricing over at Peacock. And then, for better or worse, the Colbert News over at CBS Paramount continues to get a lot of discussion. The optics coming just a few days after Colbert criticized the company for their settlement on the 60 lawsuit. How are media analysts thinking about that dynamic over at Paramount right now?
Well, starting with Paramount, it's a challenge because, as you know, and your viewers likely know, the company is in the process of moving to a new ownership structure under Skydance, and so that has yet to be completed. But for any of these companies in media where you're dealing with the challenging changes of the cord-cutting environment, the fact that businesses like Netflix and YouTube have been incredibly strong, and now some uncertainty within the company as you have a transition, that's tough. That's a tough place to be. Now, that said, we look at Paramount. I do think Paramount has some great assets, and hopefully they'll be well-positioned once they get past this transition.
Mike, appreciate it very much, talking some Paramount and Netflix. We'll get the opening bell after a short break.
Thank you.